For over 80 years, a single institution dominated Costa Rica's financial landscape with an iron grip that would make modern monopolists envious. The Banco Nacional de Costa Rica wasn't just a bank, it was the banking system itself, wielding power that extended far beyond mere financial services into the very fabric of Costa Rican society and politics. Founded in 1914 during a period of economic nationalism, this state-owned behemoth would grow to control over 60% of all banking assets in the country, making it one of the most dominant financial institutions in Central American history. Yet by 1995, this seemingly unshakable empire found itself stripped of its monopolistic powers, forced to compete in an open market that would forever change the Costa Rican financial sector. The story begins in 1914, when Costa Rica's government established the Banco Nacional as a state-owned institution designed to break the country's dependence on foreign banks and provide financial services to a growing nation. The timing was perfect. World War I had disrupted international banking, and Costa Rica needed a reliable domestic financial institution to support its coffee and banana exports. Within its first decade, the bank had established itself as the primary lender to both the government and private sector, handling everything from agricultural financing to foreign exchange transactions. By 1924, the Banco Nacional had absorbed several smaller regional banks, consolidating its position as the country's financial cornerstone. The government granted it exclusive rights to issue currency, manage public debt, and serve as the state's fiscal agent, powers that would prove nearly impossible to challenge for decades to come. The bank's monopolistic structure became even more entrenched during the 1940s under President Rafael Ángel Calderón Guardia's social reform agenda. In 1948, following Costa Rica's brief civil war, the new government led by José Figueres Ferrer nationalized the banking sector entirely, making private banking illegal and cementing the Banco Nacional's dominance alongside two other state banks that were created to serve specific sectors. The Banco de Costa Rica, originally founded in 1877 as a private institution, was nationalized and relegated to a secondary role, while the Banco Crédito Agrícola de Cartago was absorbed into the system to handle agricultural lending. This triumvirate of state banks, with Banco Nacional at its head, controlled every aspect of Costa Rican finance from checking accounts for ordinary citizens to massive infrastructure loans for government projects. By 1950, the nationalized banking system handled 100% of all formal financial transactions in the country, creating a level of state control over money and credit that was unprecedented in Latin America. The monopoly's power extended far beyond traditional banking services into areas that would astound modern observers. The Banco Nacional administered the country's social security payments, managed government payroll for over 100,000 public employees, and controlled all foreign currency exchanges at rates set by government decree rather than market forces. The bank's executives wielded enormous political influence, often serving simultaneously in key government positions and determining which businesses received credit and which were denied access to capital. During the 1960s and 1970s, the bank financed Costa Rica's ambitious social programs, including universal healthcare and education initiatives, while also funding major infrastructure projects like the Inter-American Highway and the Arenal Hydroelectric Dam. Agricultural producers were entirely dependent on the bank's credit programs, with coffee growers receiving seasonal loans at subsidized rates that made the difference between prosperity and bankruptcy. The institution became so central to daily life that most Costa Ricans knew no other banking system. Opening an account, securing a mortgage, or exchanging dollars all required dealing with one of the three state banks, with Banco Nacional serving as the ultimate authority. However, this monopolistic paradise began showing cracks during the debt crisis of the early 1980s, when Latin American economies collapsed under the weight of unsustainable borrowing and rising interest rates. Costa Rica's external debt ballooned to over $4 billion by 1982, representing more than 100% of the country's GDP, and the government found itself unable to service its obligations without dramatic reforms. The International Monetary Fund and World Bank stepped in with conditional lending packages that demanded structural adjustment programs, including the gradual opening of previously protected sectors like banking and telecommunications. Banco Nacional, which had grown complacent during decades without competition, suddenly faced pressure to modernize its operations and improve efficiency while dealing with a portfolio of non-performing loans that threatened its stability. The bank's outdated computer systems, overstaffed branches, and bureaucratic procedures became glaring weaknesses when measured against international banking standards. Political opposition to banking liberalization remained fierce, with unions and leftist parties arguing that state banking monopoly protected Costa Ricans from exploitation by foreign financial institutions. The first serious challenge to the monopoly came in 1987 when Costa Rica's Constitutional Court ruled that the complete prohibition of private banking violated citizens' economic freedoms guaranteed under the Constitution. This landmark decision forced the government to begin drafting legislation that would allow private banks to operate while maintaining state control over key financial services like checking accounts and mortgages. Banco Nacional's management recognized the existential threat and launched a modernization program that included installing new computer networks, reducing staff through early retirement programs, and establishing specialized divisions for corporate banking and international trade finance. The bank's board of directors, appointed directly by the president, fought desperately to maintain their institution's privileged position by arguing that private banks would abandon rural areas and focus only on wealthy urban clients. They commissioned studies showing that state banking kept interest rates lower and provided more equitable access to credit than purely market-driven systems in neighboring countries. The dam finally burst in 1995 when Costa Rica's Legislative Assembly passed comprehensive banking reform legislation that shattered the state monopoly once and for all. The new law allowed private banks to offer checking accounts, issue credit cards, make mortgage loans, and compete directly with state institutions in virtually every area of retail and commercial banking. International banks immediately recognized the opportunity and began establishing operations in San Jose, bringing sophisticated financial products and aggressive marketing campaigns that state banks had never encountered. Banco Nacional suddenly found itself competing against Scotiabank, which opened its first Costa Rican branch in 1996, followed quickly by Citibank, HSBC, and several regional institutions from Guatemala and Panama. These new competitors offered longer banking hours, faster loan approvals, higher interest rates on deposits, and customer service standards that exposed the deficiencies of the state banking system. Within 2 years, private banks had captured over 20% of the market for deposits and nearly 30% of new loans, eroding Banco Nacional's dominance at an alarming pace. The transformation proved devastating for Banco Nacional's traditional business model and political influence. Private banks poached the institution's most profitable corporate clients by offering competitive interest rates and personalized service that government bureaucracy could not match. The bank's foreign exchange monopoly disappeared as currency dealers and private banks offered better rates and more convenient locations for travelers and businesses. Employment at Banco Nacional dropped from over 8,000 workers in 1995 to fewer than 6,000 by 2000. As automation and competition forced the elimination of redundant positions and inefficient processes. The bank's political clout evaporated as government officials could no longer use banking services as tools of patronage and control over the private sector. Most humiliatingly, many government agencies and state-owned enterprises began moving their accounts to private banks that offered better terms and more reliable service than their former monopolistic provider. The institution that had once set the terms for all financial transactions in Costa Rica found itself scrambling to retain customers who suddenly had choices. Despite these challenges, Banco Nacional managed to survive the transition to competitive banking, though in a dramatically reduced form. The bank retained its role as the government's primary fiscal agent and continued to dominate certain sectors like agricultural lending, where its extensive rural branch network and government connections provided competitive advantages. Management implemented aggressive cost-cutting measures and invested heavily in technology to match the service standards of private competitors, though progress remained slower than in the private sector due to civil service regulations and political interference. By 2000, the bank had stabilized its market share at approximately 40% of total banking assets, still the largest single institution, but no longer the overwhelming force it had been during the monopoly era. The Costa Rican banking system as a whole benefited enormously from competition, with improved efficiency, better customer service, and increased access to credit driving economic growth and financial inclusion. Interest rate spreads between borrowing and lending rates declined significantly as competition forced all banks to operate more efficiently and offer better terms to customers. The fall of Banco Nacional's monopoly represents one of the most dramatic examples of how protected state enterprises can lose their dominance almost overnight when exposed to competitive forces. For 81 years, this institution enjoyed a level of market control that allowed it to dictate terms to an entire nation's economy. Yet within a decade of liberalization, it had been reduced to just another player in a competitive marketplace. The bank's experience illustrates both the benefits and costs of state monopolies in developing countries. While the monopoly provided financial stability and supported social programs during Costa Rica's early development, it also created inefficiencies and complacency that became liabilities once competition arrived. Today, Costa Rica's banking sector is among the most competitive in Central America, with over 30 licensed institutions serving a population of just 5 million people, a dramatic transformation from the era when 3 state banks controlled everything. The Banco Nacional continues to operate as a major commercial bank, but its monopolistic powers are just a memory, a reminder of how quickly even the most entrenched business models can become obsolete when markets open to competition and consumer choice.